Hello and welcome to this lecture on Treasury securities. I hope you're doing well from wherever it is you're joining us. In this class, we will discuss the prominent type of risk-free assets, the US Treasury securities. These are bonds sold by the US Treasury. We will characterize the US Treasury market. We will examine the distinct features of US Treasuries. We will understand the role treasuries play in global financial markets. As of 2020, the Treasury securities market is the largest debt market in the world. At this time, there were outstanding securities worth over 24 trillion US dollars. Almost every type of US financial institution owns Treasury securities. For instance, banks, mutual funds, insurance companies, pension funds, and of course the Federal Reserve. On top of that, about 1/3 of treasuries are owned by international investors. Let's start by looking at the different categories of US treasuries. US treasuries are government bonds that pay fixed interest payments over their lifetime. There are three different categories of treasuries according to their maturities. First, we have treasury bills or T-bills. T-bills have the shortest range of maturities. They go from 4 weeks through 52 weeks. They account for about 20% of US Treasury securities. Second, there are treasury notes. Notes are securities in the middle range of maturities. They are issued with maturity terms between 2 to 10 years. They account for most of US Treasury securities outstanding. Third, we have Treasury bonds. Treasury bonds are essentially identical to Treasury notes, except that they mature in 20 to 30 years. Treasury bonds are also referred to as the long bond. Why are US Treasuries so popular with investors? The main reason is that US Treasuries are considered to be free of credit risk. This means investors are guaranteed payment of both their interest and their principal as long as they hold the US Treasuries to maturity. These payments are guaranteed by the full faith and credit of the US government. Because US Treasuries bear no credit risk, they are often used as collateral in borrowing arrangements. For example, US Treasuries are often used as collateral in the multi-trillion-dollar market for repurchase agreements or repo market. This is a crucial short-term funding market for financial institutions. Finally, the interest rate on Treasury securities is considered a good measure of the risk-free interest rate. The risk-free interest rate is used as a benchmark interest rate in many financial contracts around the world. You may wonder why US Treasuries are preferred to government debt from other developed countries with no risk of default, for instance, Germany, China, or Japan. There are three main reasons. First, the US Treasury market is much bigger than any other market. At any time, a broad variety of investors are usually interested in buying treasuries. This means it is always easy to sell them with few transaction costs. When securities in a market can be easily traded with little cost, the market is called liquid. The US Treasury market is the most liquid securities market in the world. Second, most financial transactions worldwide are conducted in US dollars. Holding US Treasuries is one way to hold US dollars. For this reason, US Treasuries are often called cash-like assets. By the end of 2020, corporations and households deposited over 2 trillion of cash in money market mutual funds that only invest in US Treasury securities. Third, US Treasuries is the most common way for central banks around the world to keep dollar reserves. Is investing in US Treasuries always riskless? If you hold the Treasury until maturity, then you receive your payment. There is no risk in this case. However, if you must sell before maturity, you might take a loss. This will happen if you must sell for less than your initial investment. This can happen when the current market value of the bond falls. Treasury investors are worried about two main sources of risk. First, inflation. Second, changes in the interest rate. Let's consider each of these risks in turn. We will see how these risks can make treasuries lose value. Let's start with inflation. How does inflation affect the price of US Treasury? Suppose you bought a 52-week T-bill with a face value of $100 that has a 2% nominal interest rate. Also, let's assume you expect inflation of 2%. At maturity, you get a face value of $100 plus $2 interest. At the same time, goods that had cost $100 when you bought the bill now cost $102 due to inflation. So, with the earned interest, you can still buy exactly the same goods that you could have bought when you bought the T-bill. Now assume that this year inflation is higher, say 5%. At maturity, you still get the face value of $100 plus $2 interest. However, now the goods cost $105 due to the higher inflation rate. This means you cannot afford the same goods as before. Your nominal return was 2%, but now your real return, which adjusts for inflation, is minus 3%. When inflation is higher than expected, the market value of treasuries will decline. From today's perspective, they provide less purchasing power and therefore are worth less. Changes in the interest rates can have a similar effect. Suppose you bought a 2-year treasury note that pays 2% interest for $100. Let's assume that after 1 year you want to sell this investment. At the same time, your investment has a 1-year maturity left. How much money can you get for this note? Well, it depends on the interest rate of the closest substitute. A newly issued 52-week T-bill. If the interest rate on the newly issued 52-week T-bill is higher, say 3%, then this is more attractive as an investment than your note that pays only 2%. If the new T-bill costs $100, then the price for your investment will be less than $100. So, when interest rates increase, the market value of previously issued long-term treasuries can decline. Longer-run treasuries bear more risk that interest rates will change over the life of the bond. Compensation for this risk is called the term premium. These risks are reflected in nominal interest rates on longer-term treasuries. There are 3 components. First, the real interest rate, that is, the interest rate after taking inflation into account. Second, the expected rate of inflation. And third, the term premium, which captures longer-run risks, including interest rate changes. What have we learned in this lesson? First, the US Treasury market is the largest and most liquid debt market in the world. Second, US Treasuries have no credit risk. This means their interest rate is a good proxy for a risk-free rate. Third, long-run nominal interest rates on US Treasury securities can be decomposed into the real interest rate expected inflation, and the term premium.